So my name's Zeev Klein. Oh, that's me. Pleasure to be your host. And thank you to John. What an amazing introduction. We're going to keep this moving really fast. So session 1 is about investing. A pleasure to welcome Claudia to the stage next. She's going to provide us with an introduction on corporate venture capital, Managing Director of Venture Capital for IBM. Please join us on the stage.
Thank you, Z. Let me invite my fellow panelists up with me, Mary Kay and Jacques. Please join me up. So I know John is really hard act to follow. We're going to try to pull back a little bit and talk a little bit about the macro of venture capital. I'm Claudia from Munce. I'm Managing Director of IBM Venture Capital Group. In Neely's chart, I'm the elephant. If you ever read my ex-CEO's book about how he made the elephant dance, at least I'm not the clown, so that was good. I am also a board member of the U.S. Venture Capital Associations, and I'm here representing that board in supporting the Israel Dealmakers Summit. And happy to be a supporter of you, of course. And what I wanted to do is just take a couple of minutes on some of the data that we capture in terms of the macro venture landscape and share that with you just in a few minutes, and then I'm going to join my fellow panelists up there for a discussion. I think John did such a fantastic job. I wish I have seen his content. It will save me a lot of work. But yes, we're coming off in a fantastic year. Last year was absolutely the record-breaking year in every aspect of it. Here in the U.S., obviously, we saw incredible increase, about 62% increase in investment. Globally, we saw that same kind of a trend all over the place in China and certainly in Israel, as John talked about. And that is an increase that we saw in both investing, the number of investments are being placed, the total dollar of investment, as well as the fundraising aspect of venture capital. You see that China last year was the first year that surpassed Europe and became the number 2 in terms of the dollar invested. And Israel, obviously, we talked about that already. So it's a record year. The beauty about this record year is the majority of the deal, the dominant deal, is early stage. And for us, and those of us are living this incredible time and asking ourselves if we're in another bubble or not, the fact that we have a majority deal being an early stage deal is what we view as a sustainability of this investment trend. Now, when you pull back and think about what are the motivator, what are the driver of these records, the number of the startup, and obviously one of them is these incredible valuation that John also touched on Israel. But if you look at across the globe, there is 76 what we call the unicorn, these startup companies that have exceeded $1 billion in valuation, and of course drawing a lot of investment interest back into the community with this level of return. And the second motivation, of course, this is a data tabulating the last 5 years of investing across the globe, is the fact that everything is shifting, right? There's these huge disruptions happening in the marketplace that you see summarizing this chart. And that is actually one space that we don't think we're anywhere near a stability of identifying the de facto solution. So as we go forward, these are going to still draw a lot of investment into the community. And of course, each and every one of these, we can go in much deeper in hours and hours of discussion, but I'll leave that to the rest of the conference. And the third one is the fact that there is, crowdfunding obviously as part of that, and I love the equity component that John talked about, but also there's a huge change in the ecosystem. There are new source of capital. There's, of course, the crowdfunding, the PE, but there's also a very important component that I represent and Mary Kay represent, and that is the corporate. The corporate has come in 2014 as one of the major forces into the venture capital community. In 2014, when we closed the record year, 11% of all the capital invested here in the U.S. came from the corporate venture groups, and also 1/3 of the deal had a participant from the venture capital arms. within the corporations. And if you look at the distribution of that, is an incredible, growth as you look from the past. And if you look at the number of operators, there has been, in 2012, there were 200 and something. Today, there's over 1,100 corporations that has a corporate venture arm, such as us, operating in the entrepreneur community, seeking both the financial and the strategic value. The bigger the corporation, the more likely it is to have an arm. And one of the things we would like you to walk away from is to know that you need to get to know us. So for that purpose, I'm going to now join Mary Kay and Jacques up there, and we're going to talk about the corporate venture, and hopefully we can start a dialogue there with you. Thank you.
Claudia, I'm really impressed. We talked about your ability to do that in less than 10 minutes. I thought there was no way. You did in 6 minutes. Congratulations.
Right.
So thank you and welcome to this panel. It's a pleasure to be here this afternoon and to be with those illustrious co-panelists, which maybe if you can start by just introducing yourself in like 1 minute.
All right.
What you're looking for as a corporate venture capital group, and very importantly, when should people call you?
Okay. People should call me when they can make IBM lots of money. That's easy. I'm a corporate vice president for strategy. So it is my job to focus on the non-organic growth opportunity for IBM. And in my case, focusing on what kind of partnership, what kind of M&A opportunity that we can leverage from these clearly the disruptors of our industry and our clients' industry.
Okay.
Hi, I'm Mary Kay James. I'm with Dupont Ventures, and I have been since 2003, when our group started. So we've been doing this for, thank you, we've been doing this for a long time, and what we're looking for today are startups that encourage our new areas of growth, which would be agriculture, nutrition and health, surprising maybe for some of you from the Dupont company, and also advanced materials, maybe something that's more in our wheelhouse, but we're moving beyond. And what I would say to call us is anytime. So it's an open invitation I extend to all the entrepreneurs here. You never know when there could be a match, or you never know when we could help make a match. So please, we're very open, ranging from the stage of, we usually don't get involved in seed stage companies, but sometimes we do. The minute you say something like we usually don't, I could think of examples when we have.
Yes.
But generally, Series A, Series B, Series C, that's what we look at. Thank you.
And I'll introduce myself as we go. I'm Jacques Benkoski. I'm a partner with US Venture Partners. US Venture Partners is a leading venture capital firm on Sand Hill Road. What makes us a bit unique and why I'm here this afternoon is that we are probably the most prolific US-based investor investing in Israel. We've done so for 15 years, and we've had several amazing successes, such as Trustia that was recalled before. And John, I know it makes you jealous, but we do get phone calls from Shlomo Kramer. Anyway, we do not invest in everything he offers us, which is something that is very hard to resist, but we do. So it's a real pleasure to be here. The challenge as a co-board member, which often I find myself with corporates, is there's a time and a place where companies really get enormous leverage from having a corporate investor and a board member.
Yeah.
Sometimes it's just very distracting, and sometimes it's just not appropriate. Can you elaborate on kind of when it's right and when it's not right?
Yes. For me, the right time is as early as you can, like Mary Kay said. I mean, one thing that is a fact, and I'm not ashamed of admitting it, is the pace is very different within a corporation and with an entrepreneur. So very often, the response time expected is to be much faster than what corporate are usually comfortable with. And we're starting from scratch to get to know you. That process is going to be on our clock and not your clock. So engaging and making us aware, making us part of developing a value proposition where you can make a lot of money for us is actually a very beneficial when the time is right for us to strike. then the response time is more likely to align than making a fresh introduction when you think is the right time.
So get to know you over a long time, not expect an investment.
Yes.
Just as you get into my office and you get a check in 5 minutes. No, I'm kidding. It never happens. How about you, Mary Kay?
I'm with him.
Building relationships is very important, but I would say also so is building a startup company, and that's really what our expertise is. What I say to entrepreneurs is if you want a partner to help build your company, to provide you access to complementary technologies, to open the door to customers, to help with the supply chain, to help even leverage purchasing power. Those are all things a corporate can do. So whenever your company is ready for that, then that's what we say, engage.
And if I can comment on that, I think it's important that people listen to the words that were just spoken when you can leverage all those things. And I think it's important to recognize that there is a time where you can really leverage, and there's a time where the bear hug of, the corporation is just going to be too much, right? They're going to take too much of your time.
Yes.
Just exploring and engaging with them is more than you can afford.
Yes.
And so you have to find a time in the growth of the company when that's the most appropriate. And there's no formula. It depends on the sectors. For example, if you're more on the industrial sector, we, for example, would never invest in a company that does not have a corporate investor alongside us, because we know for a startup to go to market in those spaces is very hard.
Yeah.
On the other side, sometimes you look at some software companies where, look, just get to 200-300 customers and then talk to a corporate, right? And you have to sort of date them and get to know them and meet them and get a sense for when that is. And it can be the most amazing, the most company-changing event if you do it right. So another trend that's been going on, which we at USVP have been very glad to see happening, is corporate investors in venture funds. Can you elaborate on, you said you were doing that routinely. Yes. Can you elaborate on why you do it and what you get out of it, and compare and contrast versus direct investing?
Obviously time has changed. We have become a very strong LP to the venture funds that are strategically very well aligned to the spaces where we see grow in our own portfolio. And that LP position has initially connected us into the deal flow, into the strategic thought behind the investment, as well as that network of entrepreneurs that we wish to be connected to. Obviously, the batting average of the firm matters. The financial due diligence of the investment successes is something that we care about, but strategic is really the reason behind the fund of fund investment, is to be aligned to those people that are developing that pipeline of companies that we need to be very close to.
So the leverage, the multiplication factor.
Yes.
Yeah, us too, Claudia. What I would say too is geography is very important to us. So if we're looking to a new geography in a new sector, then the first thing that we might do is look to see what funds are there, which ones look prominent, and then which ones have a complementary set to our own, and make that fund investment. We don't. I know some groups will actually budget, like 20% of our fund will go to be an LP and other funds. No, we don't do that. It's an ad hoc discussion. We entertain them funds regularly, and then we make decisions.
So often people are worried about corporate investors because the groups have had a tendency over the last 20 years to emerge and disappear, or at least grow and shrink. Is this time different?
We think it's different. We think, and by a lot of the data that you're seeing, is different from when the corporate was just an investment component of the balance sheet versus being part of the strategic component of growing and sustaining the business. And that's what we're seeing today. The emergence of a corporate ventures that you saw in the chart earlier is to accelerate the parent company's innovation, pipeline, more than trying to get the financial return from the venture investing. I mean, from a $100 billion revenue company, any kind of return to move our needle, I mean, I have to have dozens of Ubers and beyond, right? It's really not the same as investing as part of the balance sheet. It's really investing so our business, our core business, can be sustained and grow. For that, I think it's very different.
Yep, I agree. I think you'll see this from the what I call highly strategic corporate investing groups, whereas maybe some of the ones that are purely financial, they come and go based on their own ability to perform and their corporation's need for that performance. So that's a risk. And you do want to clarify what is the operating model of the corporate venture group and figure out what is important to them. For us, ever since we started, we thought it was very important to make a strong strategic and commercial connection with a startup company along with our investment. So our investment indicates our alignment in the success of both companies. And then when you do the commercial agreement, then it's very clear what we're both heading off and trying to do together. And I think that clarity has helped contribute to the sustainability of our group.
Yes, yes.
And I can agree and compliment what was said. I think what's changed, and we saw it first on the pharma side, we see it now everywhere, is the understanding by the larger companies that there's only so much that they can innovate internally. There's only so many initiatives that they can lead successfully from beginning to the end, innovator's dilemma being the classical problem, and then have the ability to take that innovation to inspire themselves, sometimes by the company, sometimes have a strategic relationship, sometimes just understanding that business exists. It may not be a first-degree benefit. It may be that the company sells product A, that triggers sales of product B, and you're only selling product B. But there's always that leverage, and I think that's very important. Maybe, since we have just a short time, if you could just, each of you, take a great success story and maybe a not so great one, if you want to start, Mary Kay.
Oh, gosh. I don't like to admit to my not so great one.
Let's just do the good one then.
I would say the not so great examples, and we do have a few in the portfolio, would be the cases where the technology didn't work. So we're heavy into the technology. That's the reason primarily that we're looking at these startup companies, and we're deeply invested in those. But if we have a plan to try to develop it and use the technology in a way maybe that's separate or different than the startup has, and that doesn't work, that doesn't bode very well. That can be difficult. And then also, as you watch the company grow, the startup can move and change and kind of move away from its original direction. In fact, that's what they're supposed to do, right? Be the heat-seeking missile to try to find that application area. And then when you find out, oh, gosh, we no longer match the way that we did before, that can be difficult. But the Ventures Group holds the responsibility to always be working with the startup companies. So even if there isn't a business unit link as we go forward, that doesn't matter. The company's still in the portfolio.
Yeah. No, I think the most important lesson is the fact that, for you, is these corporate venture groups, such as Mary Kay's team and mine, they're here to help you navigate the strategic alignment of your company, or if you're a VC, of your portfolio. I'm a 30-year veteran of IBM, and trust me, I have IBM colleague in the audience. I'm still navigating IBM. I'm still trying to figure out who is who can champion what deal, who's got responsibility today for that particular business line. The corporate venture group is the seasoned executive inside the corporations that can help you do that navigation and help you really identify. So my best example actually was in John's chart, and also a USVP company's trustee, right? We bought that company. It came from the relationship we have with the VCs. We actually, brokered the deal from the very beginning. That kind of getting to know each other from a very strategic level and then resulting in a very successful commercial engagement is the best example. I mean, I have terrible example where the CEO want to make more money than my CEO at acquisition, and those things that did not work. But by and large, I just insist on the fact that the corporate venture are here to really help the quality of the engagement that you can have with large corporations. I'm talking on David and Goliath, right? IBM is a 400,000 employee company, and if you're an entrepreneur and you're trying to navigate that yourself, good luck. So, I think this is really what I'd like you to walk away with.
Wonderful. It's been a pleasure.
Thank
I
you,
hope
Jacques.
we help the audience understand what the role of the corporate venture is and how to turn to those two wonderful ladies. But there's a lot of other corporate venture groups in the audience, and I'm sure you'll find each other and be able to talk to one another. So thank you very much to both of you.
Thank you, Jacques.